Right, good afternoon everybody. I think it's my task to run you through the entire global technology industry in about 20 minutes, which requires me to talk even faster than I do normally. So let's see how we get on. So for those that don't know Polar Capital, we're a boutique investment manager, actually formed by the once technology team of Henderson investors in the late 90s. I joined in 2003 and have, I suppose with Nick Evans, my partner, we built a team that today is one of the largest tech managers in the world, certainly one of the largest in Europe. We have a team of 9 investment professionals, 8 based in London, 1 in Connecticut, the US. And we run 3 products, a trust, a global technology UCIT, and a kind of crossover vehicle, an automation and AI fund, which is very tech heavy, 40% or thereabouts. And then the rest of the portfolio looking for ways to benefit from technology themes, but without or beyond the technology universe. Very quickly, again, this is a lot of experience in the team. I started in the mid-90s, and we're kind of at the right age. We've grown up with this stuff, and we're still hugely fascinated by all the change that we see. You need a large team because the technology sector continues to evolve. There are lots of stocks that we didn't look at. The universe continually reinvents itself, but also it's a global industry. Right now, Shusong is in Taiwan, this chap here. We have Brad and Ali in New York. Last week, Nick was in San Francisco, and the week before that, I was in Barcelona. We're moving around all the time, trying to meet with our companies, meet with potential investments. The framework that we use is to identify themes. Where is the world changing in the real world sense, but also within technology? Themes are really important to our investment process. We try to find pure plays on themes where we can. We try to avoid value traps, last generation winners, and stuff that should be left with venture capital. We don't do very early stage investing, but companies that require capital to continue to get back to break even. We don't do that, with the odd exception. We can talk about a couple of those. Valuation, people will always talk in this industry about valuation discipline. We have our own valuation discipline, but the first thing we do is try to identify what are the key themes and which are the best stocks to hold. You don't go into a shop and say, well, I've got 47 pence, what can I buy with that? We don't do that with investment either. We try to identify what we want to hold, and then we make a decision about whether or not the price of that asset is an interesting one or not. We build our portfolio, in the case of the trust, against an index, and in the UCIT with less interest in the index, and we're very disciplined about selling. And again, fund managers tend to talk about their winners. They very rarely talk about the inevitable losers that come with investing. So we run 2 products that I could talk to today, but one has 110 stocks and one has 70 odd stocks, and both are built to withstand mistakes because we make mistakes all the time. Now, to that end, selling losers can be one of the best things you've ever done. We had a stock in the portfolio a couple of years ago. There was some bad news. The stock was down 10 or 15 on the open. We exited it, and it went down 90 in the end. So one of my favorite stories is my late father. Of course, private investors typically don't do this. It's very hard to sell losers. It's very hard to crystallize losses. So my late father was the best example of this. He had a stock in his portfolio, thankfully only a small amount of his money, or our money, in a business called British Dredging. And that stock fell 90%. And my father refused to sell it even when he found out it wasn't British and it didn't do any dredging. So I hope you haven't got too many British dredgings in your portfolio. The way that we invest is to be aware of the uniquenesses of tech. Now, the technology sector is in its sense, one of its own worst enemy. It overpromises and underdelivers typically, and then, of course, when you stop looking, blows you away. It's called, this is the hype cycle on the left-hand side, and there are lots of themes that will have been over on this side of the page that we are well aware of. Maybe it's things like, I don't know, hydrogen fuel cell from the 90s, or solar power in the early 2000s, or, right now, electric vehicles, for example. Whatever it might be, things that are likely to change the world, but just probably on a different time frame, and very possibly with very different companies to the ones that exist today. So in the late 90s, we were all hugely excited about the internet. Absolutely right theme, wrong time. Of course, 20 years on, the internet is vastly bigger than we thought it would be in the 90s, but most of those companies from the 90s went to zero. So being aware of the themes doesn't mean that you can invest in them today. And then when we build our portfolios, leaving the blue sky, understanding that it takes often longer for things to happen than we'd like, we focus here on this orange group of companies, or at least orange part of the adoption curve, where companies often look expensive, but aren't. And the reason for that, of course, is that change happens in a non-linear way. Just think about the time that you had a black and white TV at home and a colour TV. Maybe you had the black and white one in the bedroom, and then one day nobody ever bought a black and white television again. And the same applied to flat panel televisions. And at some point, it was perfectly reasonable to turn around to your friends and say you weren't going to buy a smartphone, and then it wasn't. And now 86% of the world have smartphones. We are herding creatures, and the way we invest is like herding creatures. And often the forward PEs on businesses, when they're about to inflect, is a nonsense. It's no measure at all of the value of a business. So think Google for a second. Google came public, I think, in 2004-05. We actually bought it in the IPO, and that company traded on a forward PE of about 80 times, based on analyst estimates. And of course, at the time, the business was worth $32 billion. Right now, the company has $100 billion plus on its balance sheet in net cash. And if we ignored that and just thought about what the company earns today, the company came public on a PE of less than 1. So forward PE is a very blunt instrument for trying to establish value in a growth market like Google. And then at the end of a life cycle, businesses that look cheap but aren't. We know that, if you're a black and white television maker or a radio, I don't know, whatever it might be, on the wrong end of technology, stocks can look cheap and often are for a reason. Because terminal growth rates in the technology sector are never zero. They're either a positive or almost always a negative. And so we sidestep these, we leave those to generalist investors. When a business or a theme is fully played out, we don't care what the price is, we sell it, or we hopefully hope we don't own it already, and we move to the next more interesting area. Think about this in the real world. Think about the AirPods that you see people walking around wearing in their ears. So 2 years ago, nobody wore them, or at least nobody who didn't live in Hoxton. And now you see them everywhere. And the reason is because they're actually pretty good, and they've got much better. And it's all right. All of a sudden, there's enough people wearing them that it's OK for everybody else to wear them. And so this is now the second fastest product in Apple's history in terms of selling. And from 0, you can end up with 100 million units in a space of no time at all. That's what S-curve adoption looks like. On the other side, think about the Hemingway quote, how did you go bankrupt, in 2 stages. First, very sort of gradually and then very suddenly. That's what life looks like. We all want to live to 100 and we want it to be a terminal growth rate of T minus whatever. But that's not what life looks like in cash usage in the economy. Every year, the linked network basically forecasts how much cash there will be. And that was true for a while. But at some point, people stopped taking cash. Bars frequently say no cash. Now, when I was younger, when I went to bars, they used to say no cards. Now they say no cash. And the point here is that change it happens in 2 stages. And the second stage is when you lose all your money. The backdrop is a very unusual one. I'm sure you've heard this already today. I won't spend much time on it. But what I will do is highlight this chart. So it's been terrific to be a growth investor for the last 10, 12 years. Really, really great. One of the best runs ever. And a lot of people would like that to stop. I'm very happy with that, by the way, because we're growth investors. What's interesting is that people very infrequently show you the juxtaposition of these 2 slides, which is that growth stocks have done well for a reason, or more specifically, tech stocks have done well for a reason. And the reason is here on the left, which is that if you exclude the impact of technology earnings, there has been no progress made in global equity earnings since the great financial crisis. Again, people don't tend to talk about this. They'll talk about how equities are long-term investments, and it's all true. It's just that my sector delivered all the growth. And so that's not to say that will persist. It's not to say it's healthy that that's where we are, but that is where we are. And if you think about the disruption that technology has wrought, not just the benefits to the Googles and Apples and Facebooks, but also the damage that those businesses have done to a myriad industries, you can see why we are where we are, all of the growth coming from tech. Now, people will tell you that the tech sector is bubbly, but actually, I worked in the bubble, and this is what a bubble looks like, where a sector in aggregate trades on more than 50 times earnings and more than 2 and a bit times the market. So there was nothing else to buy, anything to buy with tech stocks. But that's not true today. Tech stocks trade on around 21 times forward earnings, compared to about 18 or thereabouts on the S&P. We have the best balance sheet for any sector, in fact, the only sector in the US market with net cash on its balance sheet. And so when you adjust for those things, we don't trade much different to a market multiple. So very different to the late 90s. Now, at any given time, there can be some areas that are a bit richer or more exuberant right now. That's software, where the sector is looking relatively expensive compared to itself. And that's because this is a great sector to be in. Amazing incremental margins, 20, 30, 40% growth businesses. We'll talk about why, and almost 0 exposure to China, which we all know has been, of course, one of the biggest sources of upside and downside to global growth over the last few years. Internet stock look cheap. We'll talk about those. I mean, remarkably cheap when you consider how impressive some of those businesses are. And the gap between what we like and what we don't like actually, yes, it's wide, but nothing like it was in 2014, which was a difficult time, or 15, 16 were very difficult times for the sort of stocks that we like. Valuations are supported because the M&A backdrop is strong. Everybody wants to be a tech company. Who doesn't want to be in a high incremental margin industry with recurring revenues and on the right side of all the disruption? Of course, most people. So the M&A backdrop for software particularly has been off the charts. The valuation's being paid very full. And that's because ultimately this disruption is being driven by the likes of Google and Facebook and Tesla and all the companies you know about. And I came back from a conference recently and there were 7,500 real world businesses there trying to get advice about how to spend their IT dollars. And they all are, well, not all, 2/3 of them are basically living with this idea that the digital giants could turn up on their back door or front door the next morning. You know, will Google become a bank? Will Amazon decide to be a grocery seller and so on and so forth? Will Amazon go into distributing pharmaceutical products? This is happening and companies understand it. They need to transform themselves in order to remain relevant in a world of internet disruption. And the disruption comes on so many different vectors, but things like being able to deliver a service for free, being able to deliver it in an app or in the cloud, and then allow you in a freemium model to try a product. And if you like the product, keep it. If you don't like it, don't use it anymore. This idea of usage-based pricing is unique. It's the first time really ever in the industry that we've been able to do that. Scale that we've never really seen before and so on. Data advantages that the very large internet companies have is very significant. And maybe if we have time, we can talk to that. Any business that looks like on the left, a network where there was an expert in the middle and a whole bunch of customers around the expert are in trouble. And you can go back to eBay in the 90s and see that was true. I don't need to go into a shop and blah, blah, blah. You see Mothercare closed all its stores recently. What's fascinating about the Mothercare story, and I know this as I was once a young parent, we would go to Mothercare for advice, and we would go to Mothercare for some advice on how to do things, but also what products to buy. And now 70% of young parents go to YouTube to find out how to put the baby seat in the back of the car and what not to do in the middle of the night, and what should I do if I did this. That's where they're going. And mummy bloggers, the people that are huge influencers on these networks like Mumsnet, are where people now, product developers go to push their products, not to Mothercare. That is just one example of any business that looks like that is being disrupted by businesses like this. And so again, difficult to know how this is going to stop, and I guess you could argue why regulators are taking more of an interest in some of my businesses. AI, just beginning. But a couple of interesting data points. So in 2016, you probably read about this, DeepMind, Google now, sold for a game called Go, a very popular game in the East. And they sold for it by basically taking a bunch of computers, 2,000, 3,000 computing cores, and training all these computers in a neural network to beat the best human player on Earth. And they did that. So this year, Facebook and I think one of the universities got together and they haven't necessarily solved, but they beat some of the best players in the world at poker. Over 10,000 hands, the computer basically is solved for poker. And very recently, I think it was Google who solved for a game called StarCraft 2, which is an Activision game that you can play right now. The AI for that can be done on a laptop. And that AI is now capable of beating 99% of human players. So we are making some very significant steps forward in AI, albeit in very narrow fields. But this will be a very significant source of disruption in the years ahead. You see in retail, we've talked about Mothercare already, but just retail store closures at record highs despite a very strong US economy, and brands being what someone described as being nibbled to death. So you may not know this, but Amazon is one of the biggest sellers of batteries online because they have the distribution, because who cares about what batteries I'm buying? And so slowly but surely, I think some of these established brands are being nibbled by the ability to go direct to consumers. 2.5 billion people use Facebook every month. That's an awful lot of potential buyers for an upstart business like Harry's or others. The world basically ultimately being split into this kind of picture, which is you're either at the very high end of life, able to sell coffee for £4 a cup, or you're selling the cheap stuff in a plastic, polystyrene cup. Probably not polystyrene anymore, given that we're all very concerned about sustainability. So let's say paper cup. Anything in the middle is being really eliminated because of things like direct-to-consumer and massive brands and data. I'm going to skip that one. Demographics. So this is an interesting one. So we know about smartphones. There are billions of them. We know about the internet, the cloud. Well, if you don't, we will talk about them in the next 6 minutes. I think what's less obvious is demographics, where underpinning and underlying all of the change that we see is a different buyer, a different customer with different expectations and different behaviours. And so I think it's perfectly normal now to pick up my phone, press a button and have someone turn up in a car and collect me. Now, a few years ago, that would have been called a chauffeur. Or your mother, or your father, and now it's it's Uber, and you may love or not love Uber, but that's expectations have now been changed. So the old days of having somebody who used to pick up the phone to your minicab office and say, "Where's the cab?" and the driver would say, "He's coming up your road," and I'm in the street, and he's not coming up Those days are over, because I now know exactly how many minutes it's going to be before you arrive, and if it's more than about 3 or 4 minutes, I'm going to cancel the job. And so our behaviours are being changed completely and forever. And the demographic thing is much more severe. So 40% of people now meet online. Now, if we went back to the early 2000s, there was definitely some social stigma attached to this. I know this because my brother and my best friend both met their wives online. Both of them say that they met in bars, but they met online and then met in a bar. And now everybody meets online. 40% of all the people that get together and get married and what have you meet online. Young people feel physically ill when they're not by their devices, and they have 8-second attention spans, which when I saw that statistic made me feel vastly better about my eldest son. But it's true. Businesses have to be able to respond and fill an order and do exactly what somebody wants, because the attention span of youngsters today is violently different. And I'm not being judgmental, it's necessarily good or bad, it's just the way it is. In our portfolios, we have 8 core themes that clearly I'm not going to get around to talking about today. But the key is that this product, or the products that we run, are a collection of technology themes. So a few years ago, everybody was very excited about robotics, and maybe today it's about, electric vehicles. So we look to capture all of the most important themes in our products and look to allocate amongst them where we see the best opportunities. And so just on a high level, you can see that we're trying to move the money around according to where we see the best opportunities. This one here is where I'm going to focus in my last few minutes, which is all about 5G. I'll see if I can do a few seconds on a few of the others first. Advertising, 50% of the world now, advertising is done online. It's astonishing to me that there's still 50% of the money being put on, radio or a whole bunch of other things. If you look at where young people are, in fact, you saw probably Boris Johnson talking about the potential to get rid of the licence fee. Young people don't watch BBC. Young people don't watch TV that's being, the idea, in fact, I must tell you a funny story. So last Sunday or 2 Sundays ago, I called up to the children, come on guys, come on, Dark or whatever it's called, that thing on Sunday night is on, and come down and watch the TV. And they were like, we'll be down in a minute, Dad, we can just stream it on, iPlayer. And that was embarrassing, which of course you can do. You don't have to watch it when it's being broadcast. Broadcast TV is dead. So lots of expansion for us in the years ahead. We still have half a market to go after. But right now, Google and Facebook really own almost every incremental dollar of advertising online. And in China, companies like Alibaba and Amazon too, actually, using AI, machine learning to insert themselves between the buyer and the seller and take more of the action. E-commerce, amazing. We're still only talking about 14% of the world's retail sales being done online. So here we are, 20 years after the tech bubble, and we're still only at 14% penetration. There's lots more to go and lots more disruption for people. We own some Ocado, for example, in one of our portfolios that is helping grocers, or at least theoretically helping grocers, fight back against the likes of Amazon. We have some payment assets. Let's talk about payments quickly. Enormous market. We're still paying with pieces of plastic and pieces of paper and coin inside a piece of cow in our pockets. It's absurd, absolutely absurd. If you think about Uber and PayPal and what we're doing, and Amazon particularly, the resonance of these platforms is that we've taken payments and we've turned it invisible. So I don't care about payment. In fact, I had a very bad experience, well, not very bad, but a slightly embarrassing experience about a year ago where I jumped out of a taxi, forgetting that it wasn't an Uber. And it's true. And the guy was like, oh, you haven't paid. So don't do that. Lots of opportunity here for us, but still very early days. AI, machine learning, we've talked about a bit. I think the most important thing here is that only 1% of data today is stored and analysed. And in that, in them there are hills, there's a lot of gold. And so the amount of data that we're going to chuck off from things like autonomous vehicles, really, really exciting. And we play this in semiconductor companies, in big cloud businesses that are the sort of repository for a lot of this data and compute. And then businesses down here that are helping to apply that information, things like Illumina, that throws off tons of data with its DNA sequencers. The cloud, everybody understands now, we're still only around 20% penetrated in the cloud. The CEO of Amazon's web services business, the biggest public cloud company in the world, recently said that only 3% of the world's IT has found its way into cloud. So we're still relatively early here. The big ways of playing, Amazon, Microsoft, Google, and then some sort of choice suppliers to those businesses. Software, no time to talk about it, but we've kind of touched on the idea that disruption is everywhere. And the only way you can respond to it is by having a business that looks like Amazon and Facebook, uses data, and automates as much of the business process as possible. And that all takes you to the door of software, which is our biggest theme in our portfolios. Skip that. Robotics, automation, lots to like here. The idea of precision. You can't make an iPhone without a robot. And the ability for robots to work alongside humans is unique for this cycle. One of our kind of more peripheral themes, but something that we're very excited about on a sort of 10-year view. 5G, very quickly, I know it says time's up, tough. 5G, very quickly, is a new connectivity layer or protocol that people are going to start rolling out, partly because it's much cheaper, faster, but really it's because of the latency of 5G networks. That latency, the time it takes for something to talk and come back to respond to something on the network is absolutely critical if we're ever going to roll out things like the Internet of Things, autonomous vehicles, and some of the most exciting emerging themes that we see in front of us. And so 5G is not a cellular infrastructure technology, it's an enabling layer for edge computing. And so a fair few number of stocks in the portfolio today. Apple, very quickly, probably the best business in the world. I bought this in 2003. It's still our second or third largest holding. No growth in smartphones, but just look at the AirPod example, look at the services growth in the business, and just look at how valuable the mass affluent, their customer base and the mass affluence of that customer base, and how unique a story is that is able to effectively raise prices of something that everybody has and still manage to not lose their customers. And then just to, I suppose, wrap up, we have 8 core themes, but on top of that, we're doing work on all the emerging stuff. And some of this is, never going to happen. Some of it will happen after I've retired. But, probably the single most exciting of all of these themes is autonomous driving. And ultimately, just one stat to leave you with. We don't know the timeline on this, almost certainly longer than we would like. But at some point, because these are things that we ultimately don't use, they sit on driveways, they're 4% utilised, they fall in value, it's kind of daft to own a car. Now, Uber is, I think, made people aware of that in urban environments, but I think longer term what will happen here is that we will obviously have technology augmenting human driving up to a point where the technology, the car itself will do a better job of driving, and as the chairman or vice chairman or former vice chairman of GM said, there will be a point where the data basically makes it very obvious that all road deaths are being caused by humans, at which point we will all be legislated off the roads. So if you are a petrol head, enjoy the time you have. I hope that was interesting, and thank you very much.